All right, we'll go ahead and get started. Welcome everybody to our review of the Biden tax proposal. It's great to see we're joined by so many of our existing clients. I see a lot of trusted advisors we work with on the call and see some new folks as well. So welcome everybody. Before we get started, I'd like to cover just a few housekeeping items. Keep in mind that everything that we discuss today is around the proposed tax legislation, and it's just that, it's proposed. Nothing's changed yet, and there's still quite a bit of uncertainty around what the final legislation may look like. The figures we share with you today are going to be based on the most recent data that's published by the administration. We'll be sure to keep you updated as new information becomes available. Also, just remember that the information we share today should not be considered investment advice or financial advice. And I'm sure there's going to be some questions resulting from the information we share today. So if you do have those that come up, just write them down and we'll give you a way to get it to us for an answer at the end of the presentation. All right, so let's start with some quick introductions. My name's Brian Sack. I'm one of the managing partners here at Granite Harbor Advisors, and I'm joined this morning by the two other partners, Nick Brown and Tim Smith this morning. And at Granite Harbor, it's our goal to help families live their best life possible. Together, we have over 60 years of experience helping individuals and families navigate the financial challenges that life brings. We help them navigate difficult financial decisions associated with owning businesses, transitioning into retirement, legacy planning for kids and grandkids, and more. We do this through a comprehensive financial planning process and serving as the family's CFO. We help our clients manage their investment assets as well as the selection, implementation, and management of appropriate insurance solutions. So, we got that out of the way. If you earn over $400,000 or have accumulated assets of $3.5 million or more inside your estate, unfortunately, these proposed changes will have significant impacts to you and your family. And keep in mind that $3.5 million number includes everything of value inside your estate. It includes bank accounts, houses, businesses, retirement assets, and even life insurance policy proceeds if those policies are owned inside your estate. So if you fit into one or both of these categories, it's very important that you get familiar with the new way that your wealth may be taxed. So on our agenda today, we'll cover a few things. Number one, we're going to cover how your income may be taxed. Number two, we're going to cover how your assets may be taxed as they grow. And then finally, and most importantly, we'll cover what you might be able to do about it. So by now, we all know the proverbial blue wave has hit our country. And it means we now have Democratic control of the House, the Senate, and the presidency. But why is this important? It's important because of something called the budget reconciliation process. The primary benefit of this tool is that it requires a simple majority to pass legislation in the House and the Senate. See, normally the minority party can stall or filibuster a bill unless there's 60 votes, which would require Majority Leader Chuck Schumer to pick up 10 Republicans. However, with this budget reconciliation bill, a simple majority is all that's required. And well, we know in a 50-50 Senate, the tie-breaking vote goes to Vice President Kamala Harris. So what happens when we have one party in control of both chambers of Congress and the White House? Well, we get sweeping tax legislation like we did under Obama and the Affordable Care Act and the Tax Cuts and Jobs Act like we did under the Trump administration. Both of these presidents had the benefit of majority control in the House and the Senate. So the likelihood that we see major changes under a Biden administration in that same environment is very high. So now I'm going to turn it over to my colleague Tim Smith to get into some more detail around how Democrats could actually use this reconciliation process to affect some pretty significant change. Tim, take it away.
Thanks, Brian. So how may the Democrats end up using reconciliation as it relates to these changes, these proposed changes? Well, we know that they promised to roll back some of the tax cuts that we saw pass the last couple of years under the Trump administrations. And it's tax cuts such as income, estate tax, as well as corporate tax rates. There's a lot of talk of rolling back the state and local tax deduction cap. Many of you may remember that this was a big item in the news at the time that the legislation was passed. It in effect caps what you can deduct as far as state and local tax on your federal tax return. It capped it at $10,000. So if you were a resident of a high income tax state like California or New York, you weren't happy when they implemented this cap. And so the Democrats are talking about rolling back this deduction cap. And then the last item really has to do with expanding the refundable tax credits. So if you're a income earner over 400,000, what can you expect from these proposed tax changes? Well, what we do know is what we were promised from the campaigns last year. The Biden campaign, as well as the Biden administration this year, has promised tax increases. And that's really what we'll be talking about today. And it's the items such as income and payroll, as well as limiting deductions. We'll also be talking about increases as it relates to capital gains and gift and estates. I'll be covering the first three, and then Nick and Brian will come in and cover the last two. So let's get started. So how might the proposed changes impact income tax? This is a major change and will impact probably everybody on this call. But what they're targeting is the top marginal tax bracket that we know of right now, and that is to take it from 37% to 39.6%. But the bigger change is that the top marginal tax bracket will start at $400,000 of income. And what this chart really shows you is that where are we currently with marginal tax rates, and where are they going to take us under the proposal? And if you look at current rates today, and I want you to focus on the top marginal tax rates, because that's where the biggest impact for those on the call today. And if you look at a current single filer, they don't hit that 37% tax bracket until their income is over $523,000. A married filer doesn't hit the 37% tax bracket till their income is at $628,000. Under the proposal, both single and married will hit that top tax bracket of 39.6 when their income is over $400,000. So you can see if you're a high income earner over that $400,000 threshold, if these changes are passed, you're going to have a much larger tax bill. So how are the proposed changes going to affect payroll taxes? If you look at the current system today, 12.4% is paid into Social Security. It's split between the employer and the employee, both paying 6.2%, but it's only applicable on income up to roughly $143,000. Well, what the proposed change is looking at, or excuse me, let's talk about Medicare, because there is no cap on Medicare. It's 2.9%, again, being split between the employer and the employee. But again, it's not capped, it's on entire income earned. The proposed changes, though, are that they want to tax income over $400,000 with that Social Security tax of 6.2. That's the employee portion. With regards to self-employed individuals, 12.4%. However, 50% of that will be deductible by that self-employed individual. So let's go through a current payroll tax example. So Sally here under the example earns $550,000. She pays roughly $8,800 in Social Security tax, which is based on the 6.2 up to the threshold of $143,000. The Medicare tax is roughly $8,000 because it's on the entire $550,000 earned. So Sally's total payroll tax liability is roughly $17,000. Under the proposed changes, same income by Sally of $550,000, she's going to pay about $18,000 in Social Security tax. That calculation is made upon the 6.2 up to the threshold of 143,000, but then it kicks in again at income over $400,000. Medicare again is paid on the full boat of $550,000, but her total liability jumps to $26,000. So think about that. Our illustration is $550,000. But what if your income was 2 million or 5 million? You can see what how a major impact that would be to your tax liability. The other thing that I want to bring up that we really don't have clarity around is Social Security has always been a benefit-based program. What I mean by that is the more that you pay into it, the more that you get out of the system. So think about that. The question would be, if someone's earning $10 million, obviously the tax liability for Social Security is going to be much higher. And the question is, what benefit would an individual like that receive out of the system? Time will tell, right? But let's talk about some of the changes in how they affect the deduction limitation. And there are two in particular today that we really kind of want to focus on, and that is the 401k deduction as well as charitable contribution deductions. So the first is 401ks, and I know most everyone on the call has either contributed at one point or is contributing today to a 401k plan. And if you're earning over $400,000 today, this may not be the most tax efficient vehicle for savings going forward. But the change is that they're going from a marginal tax rate deduction to a tax credit. And so again, the change is really going to impact high income earners. So let's go through an example where Bob is 45, earning $500,000 a year. If he contributes $19,500 to his 401k as it stands today, he would get a full deduction against income for that contribution. So the tax savings on that would be a little over $7,000. Under the proposed law, Bob would receive a 26% tax credit against that contribution. So the tax credit would be for a little bit over $5,000. And so the net effect of that, the impact is that Bob ends up paying about $2,000 more in tax on the same contribution. More importantly, and I want to note though, is that Bob has almost $7,000 now in his plan where he got no tax benefit for that contribution. Additionally, when he goes to pull that money out of the plan, he's going to be taxed again. So in essence, he's going to have double taxation. So you can see that high income earners are not going to see 401k contributions as a tax effective way for savings. So now let's talk about charitable giving and how it works currently. So if you have an individual, in this case Bob again, is in the highest tax bracket of 37%. So if he's got some income, say $5,000 that falls in that bracket, and he makes a charitable contribution of $5,000, under current law, Bob receives a dollar for dollar deduction, thereby zeroing out any tax liability that he would have had on that $5,000. So now let's talk about what it would look like under the proposed policy. Now Bob's in a 39.6% tax bracket. He makes the same $5,000 contribution to charity, but now he receives a limit on the deduction of 28%. And so Bob is only going to be able to deduct $1,400 on that $5,000 contribution. What does that mean? There's an additional $580 of tax that's going to be paid. So again, the net result is that if you're a high income earner, there are going to have to be some other strategies that you put forth, because this may not be the best way for you to make charitable contributions. So now I'm going to turn the mic over to Nick, who's going to walk us through capital gains tax increases.
Yeah, so the United States has long incentivized private investment. And one of the ways that they've done that is through a more advantageous or lower long-term capital gain rate than an ordinary income tax rate. And the Biden proposal really addresses capital gains from two directions. One's during lifetime and one is at death. And we'll talk about those two proposed changes. And the first one we'll talk about is what happens during your life. So if you purchase a capital asset, real estate, stocks, collectibles, and you hang on to that capital asset for more than a year, for more than 12 months, and then sell it and realize any gain on that transaction, the growth is subject to capital gains tax. But like we just said, that capital gains tax is lower than what your ordinary income tax rate normally would have been. Under the Biden proposal, he's talking about reverting long-term capital gains rates back to ordinary income tax rates for anyone that earns over $1 million in a given year. So currently, right now, the top capital gains rate, the top long-term capital gain rate is 20%. If you earn more than $1 million in a given year, your top capital gain rate will almost double to 39.6%. Now, one thing that's important to note is any growth on those capital assets that you realize, that adds on to your income. And so we're not just talking about people that may be earning more than $1 million per year through business activity or salary. If you're a high income earner making $500,000 a year, and you've been hanging on to this piece of property that you bought 20 years ago and subsequently sell it for a $600,000 gain, well, now you've pushed yourself up into that top bracket. And so things that can defer that growth or defer that capital gain exposure become much more important. Let's look at a quick example. Under the current law, Jill and Sam, they're doing pretty well for themselves. They're making $1.2 million, and they just sold some company stock for $600,000 worth of gain. Under the current law, if you add that 20% capital gains rate, along with a 3.8% Medicare surcharge that everybody kind of picks up at $200,000 for individual filers or $250,000 for married filers, gives you a total tax rate of 23.8%, or total tax due on that $600,000 transaction of about $140,000. Under the proposal, Jill and Sam still having a great year, exact same income, exact same long-term cap gain sale. Now, instead of paying $140,000 in taxes, they're paying $260,000 in taxes. That's because now their cap gains rate is 39.6%, plus the still in existence 3.8% Medicare surcharge. So that's a huge difference, an 82% tax increase over what they would have otherwise paid. And we'll talk a little bit later in the presentation about ways that we can at least help that or defer that. Now, we mentioned that the proposal is attacking capital gains in two directions. One during your lifetime, but then the other at death. So currently, if you were to pass away and leave a capital asset to your heirs, there's a benefit called a step up in basis. Quick example, I bought my house a couple years ago. Let's say I paid $500,000 for it. Today, because the hot real estate market, it's worth $800,000. I pass away, I leave that to my kids. Well, they don't inherit just the house and its $800,000 worth of value, they also inherit a cost basis equivalent to its value on the date that I passed away. So rather than inheriting my original basis of $500,000, they inherit that asset at $800,000. One of the proposed changes is the elimination of that step up in basis. To give you a more comprehensive example, old George here's done very well for himself. He's got a home that he bought 20 years ago for $750,000. It's now worth $2.4 million. He's got a post-tax investment account that he put $1.3 million into, and through a disciplined investment philosophy, it's grown up to $4 million. So George has about $6.5 million worth of stuff, but his cost basis, what he paid for it, is only about $2 million. Well, unfortunately, George has passed away and left all of that to his heirs. If his heirs were to sell all of those assets immediately, it would be a completely tax-free transaction because their cost basis was pulled all the way up to the value of those assets on the date of George's death. Here's why this is such a big deal. Under the proposed change, if we eliminate that step up in basis, same George, same account, same house, George is still not with us. He left those things to his kids. However, they didn't inherit just the assets, they also inherited his cost basis, which means if they needed to sell all of those assets, they'd have a little under $4.4 million in capital gains exposure. And depending on the number of beneficiaries and how they structure that transaction, a portion of that could be taxed at the 39.6% rate. So what was a tax-free transaction could now owe over $1.5 million in tax. And it's important to note that this would impact everybody. This wouldn't just impact high-income earners. It wouldn't just impact people with more than $3.5 million in assets. Families that leave houses to their kids or any capital asset, what would have otherwise been a tax-free transaction is now a taxable transaction. Well, lastly, I'm turning over to Brian. He's going to talk a little bit about that in more detail and gift and estate tax increase.
All right. Hey, thanks for all the good news, man. Really appreciate that.
That's what I'm here for.
Oh my goodness. Wow. Okay, so if that wasn't good enough, we've known for a long time that the IRS taxes our income. We've known for a long time they tax us on the growth of our stuff, but they also tax us when we try to give that stuff to other people. And if we do that during life, it's called a gift tax. And if we do it at death, it's called an estate tax. And so the new proposed exemption is actually pretty significant. It's dropping back down to $3.5 million for an individual and $7 million for a married couple before that transfer tax is imposed. So let's look at a quick comparison. Under the current law, an individual today can be worth $11.7 million, or as a married couple, you can be worth up to $23.4 million before any transfer tax would be imposed. And anything above that would be taxed at 40%. So some of you on the call may already have an estate tax issue where you have an estate that's worth north of that $23.4 million if you're a married couple. And so some planning should be done in order to mitigate the impacts of that transfer tax. However, if we look at the proposed legislation, there are going to be a much larger number of families impacted by this tax. If you're a married couple with more than $7 million worth of stuff, you're going to have an estate tax due of somewhere between 40 and 45% of anything over that limit. And so that's really going to be a key focus for wealthy families moving forward. So let's look at a quick example. So we've got a lot of successful people on the call here. Anthony's no exception to that. So he's got a net estate value of $10 million. And at the death of Anthony, there would be no estate tax due under the current law because remember, he has $11.7 million that he can transfer to the next generation before any of that transfer tax would be due. But now let's look at Anthony's situation under the new Biden tax regime. So he still has that same $10 million net worth and estate value, but now he only has a $3.5 million exemption that he can apply against that. And so what happens? Well, he's got $6.5 million of his estate that's exposed to that transfer tax. And so you take $6.5 million and multiply by 40%, that gets you to a pretty large number. And so he's got a $2.6 million brand new tax bill over and above all the things that we've already been talking about: income tax liability, capital gains liability. And so this is a really significant potential change in the proposed tax law. So all of this sounds pretty scary, and probably has many of you concerned, and rightly you should be. But there's still a lot of things we don't know. Assuming some version of the Biden plan is passed into law, we'll certainly need to consider the effective date. Typically, tax legislation is prospective, meaning it takes place at some point in the future, moving forward. And many experts believe that it will have an effective date of January 1st, 2022, or maybe later. Sometimes, however, though, tax legislation is retroactive, and some believe at least parts of the plan could be enforceable effective January 1st, 2021. And a lot of experts are thinking that if they are going to retroact any of this plan, it would be easiest to apply on the estate and transfer tax versus the income and capital gains tax changes. So just ensuring that your planning has some flexibility built in is always important. But especially in the environment that we're living in today, having that flexibility, given the uncertainty and the timing and the final language of the bill, is going to be crucial. So I'm going to turn it over to Nick again to talk about what we can do with all this. So Nick, go ahead.
Yeah, thanks, Brian. So
Yep.
We've thrown a lot of numbers at people and kind of said, hey, these are the changes that are coming up. But most people probably just want to know what they can do about it, and how can I mitigate or eliminate some of these tax increases that we might be faced with. And so we want to address that so that everybody can walk away from the call with at least some hope of, hey, if I take the appropriate planning and take the appropriate steps, I might be able to kind of mitigate some of these proposals. So first, if you have income over $400,000, tax advantage assets are going to become much more valuable than other types of assets. Well, what do we mean when we say tax advantaged assets? Right now, most people, and especially high income earners, save money in one of two buckets: a pre-tax bucket or a post-tax bucket. And the difference between those two buckets is just how dollars are taxed going in and coming out of them. So by pre-tax bucket, we just mean things like retirement plans, pensions, IRAs. These are dollars that you receive but are not taxed on in the year you receive them, because you agree to place them in these qualified plans and not access them until a certain age. They also grow tax deferred in that bucket, meaning you don't owe any ongoing tax while they sit there and compound. In exchange for that, you do owe ordinary income tax when you take the money out. Contrast that with post-tax. Those are buckets where people say, hey, I want to pay my tax now. I'm going to go invest it. It could be a bank account, it could be an investment account, it could be real estate. Those capital assets we talked about a little earlier. I'm going to go invest it, and I'm only going to owe tax on the growth, on the gain, and I'm only going to have to pay that tax when I realize that gain, I realize that growth. Well, there's a third bucket that's available that becomes a lot more valuable under these proposals because it's a mix between the two. And that's what we would call tax advantaged assets. These are things that are like the post-tax bucket in the sense that we're saying, hey, I want to pay tax now. But like the pre-tax bucket, they grow tax deferred, and unlike either bucket, they can potentially be eliminated from any future tax. So tax advantaged can become a really valuable strategy for people that are faced with these tax increases or these 401k deduction limits. And those are things like Roth plans, health savings accounts, 529, and cash value life insurance. And for high income earners, probably the two most valuable would likely be some Roth planning and cash value life insurance, just by sheer nature of how those two things are taxed, right? The fact that anything that goes into a Roth, if certain restrictions are met, all your withdrawals and growth can be done tax-free. Similarly, cash value life insurance. cash value in life insurance policies has certain tax benefits where withdrawals and loans can potentially be done tax-free. Now I'll turn it over to Brian to talk about a few other strategies, especially when it comes to charitable giving and estate planning, that we can do to help mitigate some of these changes.
Yeah, sounds good. Thanks, buddy. Yeah, so, I mean, obviously, we're going to see a lot of change in how people accumulate their wealth. And if you just really think about it, if we're going to be in a rising tax environment, it probably makes sense to pay your taxes now, at least some of them, in exchange for not having to pay your taxes later when we're in that higher tax environment. But in addition to changing how we accumulate wealth tax efficiently, we're going to see some changes in how we actually give it away tax efficiently as well. So for income earners over that $400,000 limit, charitable giving, Tim mentioned it earlier, will become less tax efficient just due to the deduction limitations proposed. And so as a result, multi-year strategies will become more and more prevalent. A lot of tools are going to need to be dusted off and re-examined. A lot of these things have been around for a long time, but the ways in which we use them will need to change, and how often or the magnitude of what we use them in each year will probably change as well. So a quick review of some of them we'll go through here today. So the first one, been around a long time, donor advised funds, allows you to make a charitable deduction and then ultimately choose your beneficiary at some point down the road. How we fund those is likely going to change. We're still going to see real estate and cash as popular assets to use for donations, but again, that deduction limitation is going to come into play. We're also going to start seeing more focus on highly appreciated stock that you can actually give away in kind and then allow the charity to sell without imposing a capital gain. Charitable lead trusts, charitable remainder trusts will become more popular. Again, these things have been around for a while, but these tools are going to start getting dusted off and used more and more prevalently today. The sixth one is really an interesting one where you can actually take a retirement distribution and direct it directly to charity. A lot of people don't know that you can do that, and that does not fall under that deduction limitation. Also, life insurance proceeds can be directed directly to charity. And finally, private foundations will be re-examined and become more and more prevalent. So also, if you're in that 400K plus club, you're probably pretty happy, but timing the realization of gains will become very important. So let's say we have an effective date with this law change of January 1, 2022, and you have assets with significant unrealized gains. Well, you may want to consider realizing some of those gains, if not all of them now, under a more tax-efficient rule. Tax loss harvesting will also become much more important in liquid investment management, just because of the increased sensitivity to capital gains that Nick spent so much time on earlier. So that's going to definitely be a big part of liquid asset management moving forward. If you have stuff worth more than $3.5 million, or if you're married and your stuff is worth more than $7 million, you should strongly consider strategies to remove those assets from your taxable estate. Remember, this includes all assets like homes, cash, retirement accounts, and even life insurance proceeds. So let's talk about some of those time-tested strategies that wealthy families have used for years, but may become more and more prevalent for more families moving forward. Gifts and loans will become more popular. The reemergence of life insurance trusts to provide liquidity for estate tax bills will become more and more popular. Defective trusts and things like spousal access trusts will become an incredibly useful tool. Again, these things have been used for years, even in recent times, for wealthy families to essentially remove assets and remove value, remove future appreciation from their estate, and still retain some benefits from it. And if they're put together carefully and in the right ways, we can remove those assets from that potential estate tax exposure and still give the clients the ability to benefit in some ways from them. Generation skipping strategies will also become increasingly important. All this means is that you can actually skip a generation before that transfer tax is due. So if you pass assets down to your kids, well, it's not in their estate either. And so it can go all the way down to the grandkids level. in some cases even further if the right planning is done. And so a lot of these things, again, they're going to get dusted off. They're going to become more and more prevalent in planning for wealthy families to try to mitigate the impacts of this estate tax exposure. And we're actually going to be doing a follow-up webinar next month. We're going to co-host that with our friends at Hush Blackwell, a nationally renowned estate planning firm. And it's going to be specifically geared around estate planning strategies like this, and that wealthy families can really use these to mitigate those impacts of transfer tax. So stay tuned for that notice. It'll be coming out here in the next week or so.
So I'm sure everybody woke up this morning and said, man, I can't wait to hear about taxes for an hour. Fortunately, we'll be able to give you about 20 minutes of your life back so that you can go on and focus on other things. But that being said, we talked about a lot of items. And if we take anything away from this conversation, it's just a few key points. One, we do have Democratic control of Congress and the White House, and so the probability of tax legislation change goes up. And based on what they've said during their campaign proposal, we expect it to go up. Doesn't mean it will, but it can. The other thing is, if it does go up, it's probably going to target high-income earners and wealthy families disproportionately. And so if you fall in those categories, you want to pay particular attention to what changes are coming down the pipe and what things you can do to kind of mitigate it. Because of the highly situational nature of what we're talking about, the fact that it's proposed changes, the fact that any individual's particular tax situation could vary and answer widely, what we'd like everybody to do is, if you have some questions, if you thought of some things along the way, just jot them down and feel free to reach out to our office. Be happy to have a more in-depth conversation about the proposed changes, your individual situation, and some things you might be able to do to start planning for this. So our contact info is below. You can go to our website, graniteharbor.com, give us a call, 832-461-0789. Be more than happy to answer as many questions as we can with anybody who happen to be able to join us today. We'll also send out a link with a replay to this so that anybody can go back and watch some of the more pertinent parts. But more importantly, thanks everybody for taking the time out of your day to come and join us and hear about this. We appreciate your time, and we'll talk to you soon.
Thanks a bunch, guys. Have a great week.